Greetings, Keith Prather here with NCM, and I have the Automotive Economic Outlook. So the index this month was interesting. We got a nice sharp snapback between November and January. So we had good increase in December, jumped almost right at a full point, and then we got another good solid increase of 1.3 points in January. Again, this demand index is basically helping us understand what the economic environment looks like and what automotive sales should look like, or what the potential for automotive sales are over the next 6 months. So it's trending above the long-term range, and we can see that demand index is actually a little bit stronger than it has been going all the way back into the pre-pandemic era. So what it's painting is a pretty good environment overall for automotive. And I'll talk a little bit about a couple different things that we think are happening, but I think it tightens the market up a little bit. So we were 2.2% higher month over month and 2.5% higher year over year against, you go back to early 2024. It was actually a pretty good, pretty healthy month. So I don't think there's a lot of seasonality in there. I don't think that January just happens to be a big surge month for sales, but there could be some of that in the mix. The other piece of this is what's happening with inventories. And so inventories had started to improve. This is the inventory to sales ratio. And the inventory to sales ratio shows that inventories were climbing. We were still well short of historical ranges for inventories. We know that there's still some shortages out there. And I know a lot of you, a lot of the dealers that I've spoken to is telling me that they are feeling some models, some lines starting to become overstocked, especially on the EV front. Maybe even some in the lightweight pickup front, but other inventories are way down. I can drive a lot of dealer lots right now, and I still see a lot of stock outs, a lot of back orders, a lot of consumers still waiting on deliveries. And what we saw coming out of the last couple months is actual deceleration in the inventory to sales ratio. So it was actually contracting even further. So some of this is that transition for the OEMs and transitioning from EVs into maybe more hybrid models and some of the other models that are a little more popular at the moment. And that transition period is kind of leading to some of this inventory destocking at the time. So inventories are still about 30% lower than where they were pre-pandemic, and used vehicles are down about 3% year over year. And what we're really watching carefully is the inbound certified pre-owned inventories. Those CPOs are expected to continue to drop through April of this next year, 2026, based on just what happened in the post-pandemic leasing period patterns. And most of you, I'm preaching to the choir here because I know you're talking about it and I know you're watching for it. But that's going to continue to cut used vehicle inventories, and it's going to continue to squeeze the used market. That should be good, though, maybe for lower end new cars and new car sales, which have been kind of sluggish over the last couple of years, because that may push some used car buyers up into the new market, especially if the incentives are correct and if we've got enough of an interest rate softening to kind of help with that. So right now, used vehicles we believe are sitting on about 48 days of inventory on hand, which is actually pretty low. Uh, so again, I've talked about this in a lot of other videos this month, for NCM. But there is something economically that we do have to watch. I mean, generally, the Trump administration is doing all the right things when it comes to freeing up the economy, encouraging business investment, and to create this economic environment that should be really based on rapid growth. But we're going through a transition period, and that transition period can be a little painful. I even heard the president use almost exactly those terms. Here's what we're talking about. So when we look at Q4 data, so this is, quarter end, we got through December, data became available early this month in February. We saw that consumer spending was still very strong, great for automotive sales, a great signal for us to see is that we have a strong consumer out there. It was almost 82% of GDP. Normally, for consumer spending, we would only see that at around 72 to 73% of GDP. So consumer spending is really the big driver right now of this growth. The problem is that government spending was still accounting for almost 18% of GDP. And when we say government spending, I'm not talking about Medicare, Medicaid, or Social Security. We're not talking about that spending. We're talking about the administrative overhead. We're talking about building costs and lease on building and electricity for buildings and just the administrative overhead of running the government. Now, normally that number would be 12 to 13%. And again, Q4, it was running right at 18%. And the Trump administration sees this, they know this. They know that that's going to be one of the keys in getting the deficit down and improving overall economic activity and avoiding, frankly, what could be a really devastating risk out in the future if we get to that point where we become insolvent as a government and can't make debt payments. Right? We've already lost our AAA rating with a lot of credit agencies, with at least 3 or 4 of the big ones, which is concerning. Most sovereign nations that lose their AAA credit rating never get it back. So it's a big deal. But trimming government spending, they're looking for $1 trillion in cuts. There's a lot of speculation that may not get there, but they're going to get close, and they're going to trim 250,000 government workers through early retirements or forced layoffs. So what they're doing, though, at the same time, is they're trying to transition GDP growth spending down into the private sector. So they want individuals and they want corporations dictating where their money is going and how it's being spent. So for corporations, primarily, you're starting to hear about a lot of easing of permitting. For instance, natural gas power plants, they believe they can trim the permitting process to construct a brand new power plant from 18 months down to 6 months. That will spur a lot of construction activity. That spurs a lot of economic growth, a lot of investment, a lot of spending. I think they can do the same thing for data centers and some of the other industries that have some environmental impact. But speeding up that permitting process is pretty critical. That drives investment down here in this category, this non-residential fixed investment item. That ought to be easily up around 7, 8, 9% of total spending. So again, companies investing in automation, building out capacity, building new manufacturing facilities, just investing in their infrastructure overall. That's that spending. But then that also helps spur, residential construction. So new houses, new multifamily, and spending up in this area, buying cars, buying boats, buying RVs, buying all the big, heavy, big ticket items. That's spending up here, and it ought to be closer to the 9-10% overall. A healthy housing market can drive as much as 11% of GDP, and right now it's really underweight. So that's the challenge, and that's what they're trying to do. And so they're heavily, aggressively cutting up here, as you've seen with the Doge efforts. But what they're trying to do at the same time is spur spending down here. And what we get is this transition. And it's the fear of the transition and the physical difference in economic growth with heavy government spending versus economic growth after we trim government spending that becomes the big unknown, right? And that transition could create some pain and suffering in the process. We could see some slower economic activity kind of, or, Q2, maybe even early Q3, while we're working on this transition period. Companies like Apple, for instance, have come in and said they're going to invest $500 billion in US build out. But it's going to take them a year or more for that spending to really start hitting the ground at any material level, at a level that would start to change maybe economic activity overall as they build out and as suppliers build out and they take that 500 billion and you add a economic multiplier effect to it, and all of a sudden it becomes 2, 3, or $4 billion in actual economic activity. It takes a while, or I'm sorry, 2, maybe up to 1.2 or 1.3 trillion dollars. There we go, got the numbers right. Trillion dollars in economic activity. That takes time. And so it could be 2 to 3 years before you actually see that economic momentum get built. And it's again that transition that we're watching, and that's going to be the big factor. So Doge, let's talk about Doge for a second. As I said, 250,000 targeted layoffs. But what's interesting is it really could have a counter effect on the automotive industry and actually become a driver of activity. So commute traffic, we're already seeing after 35 days of the Trump administration, commuter traffic, like in the Washington, D.C., Virginia area, New York, Seattle, places like that, is actually way up. You're seeing it up, 15 to 20%, some areas up 100% as companies follow the government lead and they say, hey, get back in the office. And for every one worker that gets laid off, 9 are being forced back into the office. So keep that ratio in mind because anything on the commuter front is really seeing an impact and a lot of new interest. So during the transition, we just got brand new data from January and actually midway through February, and it shows that consumer sentiment took a bit of a dive. So on a month-over-month basis, between the highs coming out of the election and then kind of the uncertainty being created with tariffs and inflation and some of the concerns that they've got during this transition period, it was the fastest drop in 4 years. That doesn't tell the whole consumer sentiment story. Sentiment is still a little bit better than it was, maybe at some prior periods, but obviously we didn't like the direction that we got in early February when we got the data. Delinquency rates are still a concern as well. So we're starting to see rates right now still nationally at about 2.1%, but those are double where they were in 21. 21 was a pretty low year. So 22.1% is actually a little more normal for delinquency rates, but we're starting to see the aging on delinquencies get back up to levels that we hadn't seen since the Great Recession. So that's a concern. And the repossessions are about 19% higher than they were pre-pandemic. So we can't ignore that. So once this transition overall is over, once we see the government transition, we'll have a better reading on the economy. And I think you're going to see acceleration. You will see it start to improve. I think you'll see consumers go out and start spending again. A lot of them will start purchasing vehicles, and you'll start to see an improving environment. So our forecast for automotive, if you take a look at this is production, is automotive production. We think the year stays fairly flat coming into the third quarter. And then in the third quarter, we see acceleration through the end of the year. And this is data driven. It's based on 20 different economic metrics trained over 24 years of data. And you can see that good, strong growth curve on the back end of this. We think that continues this year. It's got a good accuracy rate. We're right just below 99% accurate 6 months out. So we're very confident in this part of the curve. We're hopeful for this part of the curve and what the model is seeing on the back end of this with more incentives and an improving market environment. Most of this is going to be because of better interest rates and the improvement on interest rates overall. So you can see on a longer term basis that if we do hit this level of production, you're talking about historic levels. And again, a lot of factors. Remember, we talked about the used car inventories going down over the next year. We talked about this transition over into more hybrids, which just seems like that's kind of where the market's head is. And so once you make that transition, then maybe you're hitting a better consumer sweet spot and we start to see more consumers jump back into the market. Easing interest rates, obviously going to be a big factor moving forward. So in summary, what we've got is GDP, number one, growing at around 2.1% based on what the Federal Reserve thinks is going to happen. I think, and the Treasury Secretary Scott Bessent believes it's going to be higher than that. Scott thinks it's going to be closer to 3%. Last year we were 2.7. I think we get closer to this rate this year. I think the Trump administration is really going to make sure they engineer it so it's at least 2.7. And by engineering, I mean in the right way. They're not going to go manipulate the data, but I mean, I think they're going to create enough of the incentives and the kinds of things that would spur enough growth to be able to get real GDP growth up to around that level. And then it kind of flattens out in the following years. Unemployment ticks up just a little bit, so we're going to watch that carefully. That's a lot of, it's going to be at the hands of the government. Again, doesn't seem to be a lot of concern from the Trump administration. We still have about 8.1 million jobs open in the U.S., so trimming government workers by about 250,000, even if there's a reciprocal layoff in the private sector for every one of those government jobs, you're still talking about 500,000 getting displaced. There's 8.1 million jobs open, and normal is about 6. So there's a little over 2.1 million jobs available above normal to absorb some of those layoffs. So, and some folks, frankly, they had a good cushy job, making a decent salary. They didn't want to retire. They're at the right age. A lot of them are just going to retire and ride off into the sunset and take their buyout and go enjoy life. So So we'll see what the actual impact is. Interest rates, lastly, the Federal Reserve does control short-term interest rates. So we think we're going to get another 50 basis points in 24 and 25, and then maybe another 50 in 2026. I didn't talk a lot about tariffs. I mean, tariffs are going to have a bit of an impact. I've got it in the briefing. If you go read the briefing, you'll see some highlights there about the average tariff rate. The impacts between just aluminum and steel prices alone could push the average price per vehicle up 3 to 4%. So there are some concerns out there now. The Trump administration will issue some exceptions to tariffs, and I think you'll see a lot of those aimed at the automotive industry because right now he's got a lot of lobbyists in his ear telling him that he's going to impact U.S. auto manufacturers pretty heavily. And I think he will soften some of those restrictions up a little bit as we move forward. So um, again, we'll keep an eye on this. There's going to be a lot of moving parts over the next month. So next month, when we get the update, we'll know a little bit more about tariffs and tariff impacts and exclusions and really what that's going to do to the overall economy. We'll have a little better gauge on unemployment and what the government layoffs are doing in terms of government spending. And so we'll dive into that a little more deeper next month. So until then, hope everyone's doing well. Stay safe, and we'll see you next month. All right, take care.